The idea of fully opening Canada's banking market to American megabanks is a profound one. It represents a fundamental question about economic sovereignty and the structure of a nation's financial system. This is not merely a technical adjustment of regulations. It is a decision that would ripple through every corner of the Canadian economy, affecting households, businesses, and the very stability of the nation's financial architecture. The debate touches upon the delicate balance between fostering greater competition, which can lead to lower prices and better services for consumers, and preserving the domestic control and prudential oversight that has served Canada so well, particularly during times of global financial stress. Understanding what could happen is crucial for every citizen. This matters because a country's banking system is its economic lifeblood. It channels savings into productive investments. The prospect of allowing foreign giants, with balance sheets larger than Canada's entire GDP, to operate without restriction presents both immense opportunities and significant risks. The change could unleash a wave of innovation and efficiency, but it could also expose the Canadian economy to decisions made in boardrooms in New York, driven by global strategies that may not always align with Canada's national interests. The discussion is timely, arriving as the world grapples with the forces of digitalization and globalization. Today is October 8, 2025, and financial technology, or fintech, has already begun to blur traditional borders, making the old rules of banking seem increasingly antiquated. Open banking frameworks are gaining traction globally, empowering consumers with control over their financial data. In this context, the question is not just if Canada's banking system will face greater foreign competition, but how it should manage that evolution. A thoughtful, deliberate approach is required to harness the potential benefits while constructing robust safeguards against the inherent dangers of such a monumental shift. Therefore, this essay will explore a clear, fact-based scenario of what full financial liberalization between Canada and the United States could entail. Today, the Canadian banking sector stands as a model of stability and resilience, often described as a fortress. Its structure is dominated by 6 major domestic banks: Royal Bank of Canada, Toronto, Dominion Bank, Scotiabank Bank of Montreal, CIBC National Bank of Canada. Together, these institutions, known colloquially as the Big Six, command an overwhelming share of the market, holding approximately 90% of all banking assets in the country. This high degree of concentration is a defining feature of the Canadian system. It has been credited with providing a steady hand through turbulent economic waters, most notably during the 2008 global financial crisis, where no Canadian bank required a bailout, and again during the recent pandemic. The system's stability is underpinned by a robust regulatory framework enforced by OSFI. Canadian banks face stringent capital adequacy and liquidity requirements, often more conservative than international standards. These rules force banks to hold substantial capital buffers that cushion unexpected losses and help ensure continued lending during downturns. In stark contrast to Canada's concentrated and stable market, the United States banking sector is a sprawling, fiercely competitive arena, populated by thousands of institutions. At its apex are the megabanks, leviathans of global finance like J.P. Morgan Chase Bank of America, Citigroup, Wells Fargo. The sheer scale of these institutions is difficult to comprehend. The total assets of a single one of these top-tier U.S. banks can exceed the combined assets of all of Canada's Big Six. This immense size gives them unparalleled advantages in terms of economies of scale diversification ability to absorb massive investments in strategic initiatives, particularly in technology. The primary weapon in the arsenal of these American giants is their technological prowess. They have operated for years in a highly fragmented and competitive domestic market, forced to invest astronomical sums into digital transformation to win and retain customers. They are leaders in developing and deploying sophisticated mobile banking applications, artificial intelligence-driven data analytics, personalized product offerings, seamless digital payment systems. Their research and development budgets for technology dwarf those of their Canadian peers. This allows them to experiment with innovations. Perfect innovations, scale innovations at a pace unattainable for smaller institutions. This technological edge would be their most potent tool in any new market entry. If the legislative and regulatory floodgates were opened, allowing U.S. megabanks to establish full-service domestic operations in Canada, the competitive landscape would be irrevocably altered. The initial impact would be a seismic shock to the comfortable equilibrium of the Canadian banking sector. American giants would likely target the most profitable segments first: urban retail banking, credit cards, wealth management for high-net-worth individuals, commercial lending to mid-sized businesses. Their entry would not be timid or tentative. It would be well-funded, technologically sophisticated, and an aggressive push for market share, leveraging powerful brand recognition and vast marketing budgets to attract Canadian customers. The most immediate battleground would be overprice and product features. U.S. banks could introduce products common in the American market, but less so in Canada. No-fee checking accounts with minimal conditions, high-interest savings accounts, credit cards with more generous rewards programs. Leveraging lower funding costs and greater operational efficiencies, they could offer more competitive rates on mortgages and personal loans. The introduction of intense competition from U.S. megabanks, while disruptive, holds the promise of substantial benefits for Canadian consumers and the broader economy. The most direct and tangible advantage would be a marked improvement in choice and pricing, a marked reduction in common banking fees, more competitive interest rates on mortgages and loans, higher yields on savings deposits. The pressure to win customers would force all banks to offer more attractive terms, putting more money back into the pockets of households and small businesses across the country. Beyond better prices, consumers would benefit from a surge in product innovation and service quality. Faster, smarter mobile banking apps, cleaner, user-friendly online interfaces, personalized tools to help people budget, personalized tools to help people save, personalized tools to help people invest more effectively. The competition could also spur innovation in areas like real-time payments and more flexible lending products, making financial transactions faster, cheaper, and more convenient for everyone. The overall customer experience would become a key competitive differentiator. The specter of risk: sovereignty, jobs, and financial stability. Sovereignty, jobs, financial stability. Despite the potential benefits, the full-scale entry of U.S. megabanks into Canada is fraught with significant and complex risks. The most fundamental of these is the potential erosion of Canada's financial sovereignty. Banks are not ordinary businesses. They are critical infrastructure. If a large portion of the domestic banking system were controlled by foreign entities, key strategic decisions affecting the Canadian economy would be made in New York or Charlotte, guided by a global corporate strategy rather than Canada's national interest. In a severe financial crisis, a foreign parent bank might be pressured to prioritize its home market, potentially scaling back lending in Canada at the worst possible time. A second major concern revolves around employment. The Canadian banking sector is a major employer of high-skilled, well-paid professionals. The arrival of U.S. giants, with their focus on hyper-efficiency and centralized operations, could lead to significant job displacement. While they would need to hire customer-facing staff in Canada, a phased approach, a deliberate path to liberalization. Given the profound benefits and severe risks, a big bang approach to opening Canada's banking sector would be reckless. A far more prudent strategy is gradual phased conditional liberalization. This approach would allow Canada to carefully introduce competition, assess its impact, and adjust its regulatory framework in real time, thereby capturing the upside of innovation while building safeguards against instability. The first phase of this plan must be the establishment of clear, non-negotiable rules of entry that prioritize Canadian financial stability and consumer protection above all else. This means rejecting any model of branch banking from abroad, building the guardrails, safeguards for a new banking era. A phased approach is necessary, but it is insufficient on its own. It must be accompanied by strong, permanent regulatory guardrails designed to protect the Canadian economy and consumers. The first safeguard: empower consumers through enhanced competition tools, accelerate and strengthen open banking, create standardized secure APIs, Let consumers safely share financial data with third-party providers. This includes new banking entrants. That lowers switching costs and lets customers move to the best value provider. Second, establish a robust cross-border supervisory framework, not informal, a formal treaty or memorandum of understanding, between Canadian regulators like OSFI and the Bank of Canada, and U.S. counterparts like the Federal Reserve and the FDIC. A new joint supervisory council would oversee the largest cross-border institutions. It would conduct joint stress tests. It would share supervisory information in real time. And it would develop a clear, credible resolution plan to wind down a failing cross-border bank safely. Conclusion: a measured path to a more competitive future. In conclusion, the prospect of U.S. megabanks entering the Canadian market presents a classic policy dilemma, balancing the promise of dynamic competition against the risk of systemic instability. The current Canadian banking system, with its concentrated structure and conservative regulation, has delivered remarkable stability, a public good of immeasurable value. However, this stability has come at the cost of less vigorous competition, potentially leaving Canadian consumers and businesses with higher costs and fewer innovative choices than their American counterparts. A sudden, unregulated opening of the borders would be a reckless gamble with the nation's economic health. The analysis shows that American banks possess the scale, technology, and competitive drive to significantly disrupt the Canadian status quo. This disruption carries clear potential benefits: lower prices, better digital services, more credit availability, which could stimulate economic vitality. Yet, the risks are equally clear and profound. Erosion of financial sovereignty, the potential for high-value job losses, and the introduction of new systemic risks related to cross-border contagion are threats that must be taken with the utmost seriousness.